I asked GPT-4, about the recent banking collapses, and boy did it have a lot to say. Bank failures and their impact. A look at Signature Bank and Silicon Valley Bank. In the ever-changing realm of finance, bank collapses are not a rarity. However, the recent failure of two prominent banks, Signature Bank and Silicon Valley Bank, has prompted discussions about deposit safety and the government's responsibility in maintaining financial stability. In this article, we will delve into the factors behind these banks' downfalls, the arguments concerning government involvement, and the implications for the banking industry's future. Comprehending bank failures. Bank failures transpire when a financial institution is unable to fulfill its obligations to depositors and creditors. For Signature Bank and Silicon Valley Bank, their primary downfall was due to bank runs, which occur when a multitude of depositors simultaneously request to withdraw their money. When banks lack the cash reserves to accommodate these withdrawals, liquidity crises may arise, potentially leading to insolvency crises if long-term assets, such as bonds, must be sold at a loss. Interest rates and their impact. Interest rates hold significant influence over a bank's financial well-being. Rapidly rising interest rates can devalue long-term assets like bonds, rendering it challenging for banks to sell these assets without suffering losses. In the case of Signature Bank and Silicon Valley Bank, quickly escalating interest rates compelled them to sell long-term assets at a loss, exacerbating their liquidity crises and culminating in their insolvency. Government involvement and the ensuing debate. When banks fail, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per account. However, numerous accounts within these two banks exceeded this insured limit, leading to demands for the government to guarantee all deposits. Consequently, the U.S. government intervened, invoking a systemic risk exception to avert further panic and financial instability. This decision ignited debates over the government's role in such situations. Detractors contend that government assistance is exclusive to particular individuals or institutions, while supporters assert that this intervention differs from conventional bailouts, as it solely applies to depositors and not executives or shareholders. The deregulation controversy. A contentious aspect of these bank failures revolves around the financial industry's deregulation. Silicon Valley Bank's CEO, Greg Becker, had advocated for reduced regulatory oversight of his bank, asserting that it was not systemically significant. However, once the bank faced insolvency, it was deemed systemically risky and received government aid. This contradiction underscores the banking industry's double standard, where banks desire fewer regulations but anticipate bailouts when difficulties arise. The failures of these prominent banks and the government's intervention deliver a clear message to depositors: for the safety of your money, opt for banks considered too big to fail. This may prompt a shift in the banking landscape, with an increasing number of individuals choosing to bank with larger institutions more likely to receive government backing during crises. Signature Bank and Silicon Valley Bank's collapses emphasize the importance of financial stability and appropriate regulation in preventing such crises. Additionally, the need for sufficient cash reserves and preparedness for unexpected events like bank runs is highlighted. The recent failures of Signature Bank and Silicon Valley Bank have ignited discussions about deposit safety, the government's role in ensuring financial stability, and the future of the banking sector. Although it is impossible to foresee the precise impact of these events on the financial world, it is evident that they have reignited debates on the necessity of proper regulation, oversight, and transparency within the banking sector. As depositors and policymakers grapple with the aftermath of these failures, it is crucial to learn from this experience and work towards establishing a more stable and resilient financial system. Ultimately, preventing similar crises in the future necessitates a balance between fostering innovation and growth through deregulation and ensuring the financial system's safety and stability through regulation. Looking ahead, banks must prioritize transparency and accountability in their operations. This involves regularly reporting their financial health, risk exposures, and adherence to regulatory requirements. Enhanced transparency will not only improve the public's trust in the banking sector, but also enable regulators to effectively monitor and address potential risks. Moreover, regulators should constantly evaluate and update existing regulations to keep pace with the evolving financial landscape. This includes addressing the emergence of new financial products and services, as well as identifying potential systemic risks. By staying ahead of these changes, regulators can better mitigate the risk of future bank failures. It is also important for the government and regulatory bodies to establish a clear framework for dealing with insolvent banks, outlining the extent of government involvement and support. This can help minimize moral hazard and ensure that banks understand the consequences of their actions, fostering responsible behavior and risk management practices. For depositors, it is crucial to be aware of the risks associated with holding deposits in a particular bank and consider diversifying their deposits across different financial institutions. Additionally, depositors should remain informed about the financial health of their banks, enabling them to make informed decisions and take timely action if necessary. In conclusion, the failures of Signature Bank and Silicon Valley Bank serve as a stark reminder of the need for vigilance and continuous improvement in the financial sector. By fostering a balance between innovation and stability through effective regulation, transparency, and responsible banking practices, the industry can work towards preventing future bank collapses and promoting a robust and secure financial system. If you enjoyed this deep dive into the world of bank failures and their impact, don't miss out on more insightful content like this. Be sure to like and subscribe to our channel for a wealth of AI-generated content that explores a variety of topics and keeps you informed. Stay tuned for more.